Hi, and welcome to your next edition of CandleCharts.com highlights, trading strategies for those who are students of CandleCharts.com or CandleCharts Academy. And what we're going to be looking at today is protective stops. When we place a trade, and I strongly suggest whenever you place a trade, the first thing you should really be thinking about is protecting your assets, picking a price that says you're wrong. And I personally do it before I place the trade because that's when I'm most objective. It's unfortunately human nature once we're in the trade that if we have a so-called mental stop, in other words, not putting in a stop immediately when we place the trade, we'll kind of second guess ourselves. And we keep on moving and moving the stop because being in a losing position hurts our ego. So we hope for the market to turn around, and of course it never does. So one suggestion is, again, picking out a stop level, and when you put on the trade, immediately place your protective stop. And just to get a sense of how important stops are, back when I was learning candlesticks, I was giving trading recommendations. I was working for some brokerage firms, and my job was giving trade recommendations to the brokers throughout the country and the world. And this was the P&L for our department, and you could see I had the best profit and loss. And the reason I wanted to, and this was strictly because of candlesticks, and this really gave me the incentive to keep on spending the money and time and other resources into uncovering what I call these secrets of the Orient, that is the candlestick charts that we now share with you at CandleCharts.com. But anyway, getting back to this, you could see that I had the best track record, but interestingly, notice I had more losses than wins. And the reason my P&L was so good relative to all the other analysts was because I used protective stops judiciously. I made sure that I always had a protective stop. So let's look at a case in point here. So here we have a market, and these are some of the things that I personally look at. I look at Bollinger Bands. I look at a 20 and a 50-day moving average to get the longer-term sense of trend. And so here, let's look at, here we have a nice hammer. And the hammer is actually a support area. But if we buy on the hammer, we should have a protective stop under the low of the hammer. And notice on this session here, we not only closed under the low of the hammer, but it gapped down. So if we were long here, yes, it would hurt our ego to be out, but it's a lot better being out at this much of a loss. Let's say we bought it here, this much of a loss, than riding a loss down here. Another case in point here on the second blue arrow, a bullish engulfing pattern. Let me remove the arrow so you can see it's the white wrapping around the black real body, a bullish engulfing pattern. And it's at the bottom end of a Bollinger Band, which is telling us the market's oversold. So if we happen to buy here on this bullish engulfing pattern, we should have a protective stop under the low of the bullish engulfing pattern. And by the way, almost all the candlestick signals can be used as stop out levels. And for more information about which candle signals can and can't be used, I'll give you a way to get more resources at the end of the session to continue your education. But getting back to this, we have a bullish engulfing pattern. So here is the low of the bullish engulfing pattern, and the market closed under it here, so we would have had a loss. We would say we bought it here and over here. So yes, it's a loss, but it's better than having this much of a sell-off going against us. And here we have another bullish engulfing pattern that I just highlighted with the blue arrow. And this worked out really well. If we bought it here, we would have had a stop here. And notice how the market rallied after. So the hammer, the bullish engulfing pattern here and here all had the potential for reversals. And what told us we were wrong is if the market got under the lows of these patterns. So this one held very nicely, and we were able to get a nice profit on this one. Now, for those who are new to candles, I just want to remind you, if you go to my website, CandleCharts.com, we have a free glossary, and it has the key, a little bit about each of the candlestick signals. It has how candlestick charts work, so there's a great resource for you, so you could visit that. And speaking of a great resource, one of the issues that many traders have is the fact that trading can be a little bit overwhelming. What we say is paralysis by analysis. So what we're going to be doing is doing a special seminar, calling it the KISS seminar. Keep it simple and straightforward. And that is coming up very soon. And we're keeping it, the seminar itself, very simple concepts. You're going to learn the 4 C's of trading, simple step 1. And simple step 2 is you're going to walk away with a trading template, the KISS trading template. This will be an online seminar. You don't have to worry about the weather. You don't have to worry about hotel expenses. And it's a short session. It's 3 hours, so it's a great way to really hone in the key points on how to make your trading very, very simple with strategies we've developed here at candlecharts.com. So we have special pricing that's going to be ending very, very soon. Go to this link here at nisonspecial.com, KISS seminar, for more details. Thanks for joining us at candlecharts.com.